Consolidated EPS stand at rupees 13.01 as against 18.13 in last year corresponding quarter. Now moving on to segmental business performance. Starting with the Agri machinery business, the domestic tractor industry volume for the quarter ended June 2022 went up by 15.8% to 2.66 lakh tractors as compared to 2.29 lakh tractors in last year corresponding quarter. This is on a low base of last year, especially of April-May, when the rural part of country was severely impacted due to COVID-19 second wave. This is highest ever industry volume for April to June quarter. We also recorded our highest ever Q1 volume at 24,608 tractors in quarter ended June 2022, as against 24,500 tractors in the last corresponding quarter. Our growth in volume was lower than industry growth. The market share loss has mainly come from our strong markets, and that too from a particular HP segment where industry shift has happened. We are putting in place corrective actions and we hope to soon catch up with our market share growth trajectory. On export side, industry was up by 32% to 35,146 tractors as compared to 26,660 tractors in last year corresponding quarter. Our export volumes were even forever highest quarterly volumes, and the same went up by 52.5% to 2,189 tractors in quarter ended June 2022, as against 1,435 tractors in last year corresponding quarter. This is driven by our continued focus on product development for export markets and expanding our channel footprint. Sales through global Kubota network has also been increasing and now constitute more than 20% of our total export volume. We have taken price increases across our business segment to partially offset the impact of inflation on raw material and other costs. We are deeply focused on our cost reduction efforts, both in variable costs as well as in fixed costs. However, steep inflation in commodity prices coupled with unfavorable product mix due to industry shift towards lower horsepower segment has adversely impacted operating profit for the quarter ended June 2022. EBIT margin for Agri machinery business stands at 10.6% as against 14.9% in same period last quarter. With expectations of a good monsoon and likely record kharif crop production, we expect tractor industry to perform better in FY23 as compared to last fiscal. The growth in our estimate should be in low to mid single digit levels. Now coming to the construction equipment business, in quarter ended June 2022, our served industry volumes of crane, backhoe loaders and compactors went up by 47% as compared to last year corresponding quarter. Backhoe loader industry grew by 55%, crane industry grew by 40%, while compactor industry was almost flat. Our total volumes of manufactured and traded products went up by 59.4% to 966 machines as against 606 machines in last year corresponding quarter. Our crane segment has outperformed industry, resulting in market share gain by almost 10% to 43% level in quarter ended June 2022 as compared to 33% in last year corresponding quarter and 40% in sequential quarter. Segment revenue for the quarter ended June 2022 went up by 74% at 246.1 crore as against 141.1 crore in last year corresponding quarter. EBIT margin for the quarter ended June 2022 was up by 332 basis points to 1% as against negative 2.3% in last year corresponding quarter. The margins were adversely impacted due to steep inflation in commodity prices. With government thrust on infrastructure, we expect growth momentum to further accelerate in the current fiscal year 2022-23. We expect construction equipment segment to grow in high teens and margins for the segment to improve gradually owing to our various cost reduction initiatives and improvements in other operating matrices. So coming to the railway division, revenue for the quarter ended June 2022 went up by 45.2% to 173.4 crores as against 119.4 crores in last year corresponding quarter. Sales from new products now contribute 67% to total division sale as against 63% in last year corresponding quarter. EBIT margin for the quarter ended June 2022 stood at 13.6% as against 14.6% in previous years. We are working towards indigenization of new products and we are happy to share that indigenously developed axle-mounted disc brake system are dispatched for field trials and expected to go under commercialization as per the approval process. This quarter we witnessed very good traction in tendering process from wagon builders and order book for the division at the end of June 2022 stood at a healthy level of more than 850 crores. For FY23, we expect railway equipment segment continue to grow in double digits. Now I request the moderator to kindly open the floor for Q&A.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of A. Pirani from JP Morgan. Please go ahead.
Is actually on the market share performance that you mentioned. So in one of the slides, you mentioned that north and central regions for the industry grew by around 22%, but you grew by around 4%. So given that these are our traditionally strong areas, what has driven the significant underperformance in growth?
Hey, this is Shenu. So we know that we have lost in our strong markets, and we know that we have lost in some particular customer segments, especially the haulage segments or the low-end segments. As you know that we have been under unprecedented inflationary pressures since November 2020. And we were in a situation where we had to just balance out our profitability and our market share goals, right? So we took some very measured steps balancing the two, and in the process, it seems that we have lost some market share. The root cause of this loss is quite clear to us. We know exactly in which segments, in which horsepower, in which markets we have lost and to who. And now, since we are seeing some positives in terms of inflationary trends, also in terms of some of the cost savings that we were working on kicking in now, so we think this is the right time to go back to our market share goals. So yeah, we hope that in a few months from now, you will see that turnaround in market share.
Okay. So just as a follow-up, you have been, to some extent, prioritizing profitability over market share for the last few quarters as well. But in this quarter, the profitability has also been impacted. So would it be right to say that if you went for market share, then the financial performance could have been even weaker? Is that what we should understand from this?
Yeah, for that, if you compare our results with the other companies in our space for which data is publicly available, I think you would get that sense. It will be very hypothetical to say that, if we would have done better on market share, would we have lost more profit? I wouldn't like to comment on that. But yes, directionally, we were trying to balance the two, the market share and the profit.
Okay. And so just lastly, would you give any update on the expectation for tractor industry growth for the year? I think the last time when we spoke, you were expecting a mid to high single digit kind of a growth on a full year basis. If there is any update on that, that will be my last question. Thank you.
Yeah, as Bharat has said in his opening comments, right now our expectation is that the tractor industry for FY23 should be in low to mid single digit level growth from last year. So a lot depends, how things fare up in the rest of the months, but this is what we think right now.
Sure, sir. Thank you. I'll come back in the queue.
Thank you.
Thank you. We have the next question from the line of Gunjan from Bank of America. Please go ahead.
Yeah, hi. Hi, team. Thanks for taking my questions. Just, taking on the point from the earlier question, I'm still very perplexed to see this margin performance. It's almost a 5 percentage point decline. Now, when I looked at, there was no loss of operating leverage as such from a quarter to quarter. We did try to take some price increases or work on, balancing the profitability. My sense is you guys wouldn't have gone too aggressive on discounting given the focus, given, you've been, from a market share perspective, we haven't seen that reflect. So, if you can help us map this, how much was the cost increase? Did we take any price increases? Because 5% just seems a pretty steep decline Q1Q. And also on the ASP, if you can give some color, because that's also come up sequentially. So what's happening on the product mix side?
Yeah, Gunjan. If you look at our profit sequentially, you will see that the most of the loss has come from inflation itself. Even comparing quarter one of last year to quarter one of this year, that is the key reason. We are not really expecting that inflation would be so high in this last quarter. But really, the commodity prices went up in March and April. Beyond our expectations.
Were there any price increases?
Yeah. So coming to price increases, so we took one price increase in quarter one, I think to the extent of roughly 2%. So that we took, but the inflation was like much more than that.
And mix side, because still, 2% price increase, so I'm guessing that there should be some mix deterioration also here.
Yeah, so industry has shifted. To kind of lower, lesser profitable segments. You know that FY21, the rural economy was doing very well, and we saw a very significant shift to more expensive tractors or higher horsepower tractors. So that correction is also now taking place. It took place last year and it's taking place now.
Okay, got it. The second question is on, maybe related questions. One, market share, did ask about it, but, can you, give us more sense on who is, in your strong markets? Is it the price discount which is enabling the share gains for the competitors, or it is sheer weaker positioning in certain product segments like you yourself, called out haulage? So is that something we should keep in mind when we're thinking about market share? And secondly, I think this was also a first quarter after the open offer got concluded. So maybe, if you can share your thoughts as to, how are the initial conversations in terms of integrating the two brands going on?
Yeah. So firstly, Gunjan, on the market share side, yes, we have done our analysis. In fact, we have been continuously looking at it every month since we have been losing market share. And, the root cause is quite clear to us. We know what needs to be done, and we know in which segments we have to do better. Now, just in terms of timing, as I explained, we think that this is the time to go back to our market share goals because of the factors I described. Inflation pressure is going down, and not that we have no unabsorbed inflation right now, but still there is some softness in the commodity prices. So we hope that will help us in the ensuing quarters. And also some of the cost reduction initiatives we took in the previous quarters are now kicking in into good savings. Right, so this is the time to focus back now on market share. It was just a call. Different companies take different calls, and we just wanted to make sure that we balance our market share and profit aspirations. There is nothing fundamentally wrong with our market positioning that I can say very confidently. So give us a few months and you will see some turnaround in market share. Now, coming to integration part, yes, we are, in the last few months, we have been deliberating over a midterm business plan for FY28 and FY30 as to how we will use the strengths of Escorts and Kubota, both the partners, to strengthen our market share presence in the country and also overseas. So we are hoping that we will complete this by September sometime, and immediately after that, we would like to share this with you.
Okay, I'll join back with you. Thank you.
Thank you. We have the next question from the line of Chirag. Please go ahead.
Yeah, thanks, sir. Sir, just follow up on the market share thing. You mentioned that you lost market share to some kind of competitors, but would that be more of a local or a regional brands or sort of a national brands that you would have lost your market share? Because even national brands would have faced similar headwinds with respect to, let's say, profitability versus market share kind of, let's say, whatever dynamics. So maybe some color around that?
Yeah, I mean, there are hardly any regional brands really. I mean, you know, all the players are active nationally. Of course, they have different strengths in different markets. In our case, whoever we lost to is not like a single player. You know, it depends on the market, the segment, etc. Right? But generally speaking, we lost in more price-sensitive markets, more price-sensitive customer segments, right? And the answer or the response to this when we run our market share revival story now would not be discounting, and it would be a mix of several things, including positioning the right product or come up with some different variants to appeal to those particular segments, etc.
Okay. And second, also in terms of, let's say, the way monsoon has been progressing, what we understand is that UP and Bihar, they are lagging in terms of the rainfall so far. So any specific comments on those regions, markets, and what could be the implication for the tractor industry or, let's say, the broader rural segment in those regions?
Yeah, that is right. I mean, monsoon has been a little bit uneven. UP, Bihar, and some parts of MP have not received as much rainfall. But I think looking at the forecast from the weather agencies, it seems that it will get covered up. If it does not, then of course it has tendency to impact the market. Now you also know that more than the monsoon, it is actually the availability of water in various reservoirs that affects the tractor industry in immediate sense, right? But that situation is quite positive throughout the country actually. We have plenty of water in the reservoirs, and therefore even if some few areas get a little bit less rainfall, I think it should not affect the industry this year. It may affect it next year, but it may not affect this year.
Okay. And just last thing, maybe if you can share the channel inventory both for us and for the industry. Thank you so much.
Yeah, we are still within the range of roughly a month of channel inventory, let us say between 27, 28 to about 35 days. That is where we maintain our channel inventory and have been maintaining at those levels. I think the competition is slightly more than that, maybe a couple of weeks more than that.
Okay, thank you so much, sir.
Thank you. We have the next question from the line of Mitul Shah from Reliance Securities. Please go ahead.
Yes, sir. Thank you for taking my question. So again, question on margin side. So in terms of product mix, HP wise, there seems to be hardly difference of around 100-200 basis. Earlier, we used to have 91% contribution coming from 30 HP onward. This quarter, it is around 89%. So just 200 basis not explaining pure pressure on the margin because of the product mix. So is there anything to do with the intensified competition, or earlier our leader has given discounts in previous quarters to gain market share? So that is creating any pressure? Do you feel that for this quarter? And we also following the similar strategy of slightly higher discount?
Yeah, Mitul, this is Shenu. I can't answer that specifically, but yeah, there is. We do feel that there is some disparity that has happened in the customer end prices or the transaction prices with the customer, in spite of the fact that most of the industry players have increased their prices in the similar ballpark. I don't know how to read that, but when we compare transaction prices, it seems there is some distortion between our prices and competition prices.
So second question is on, as you indicated, mid-single digit growth for the full year, but can you give more visibility, at least for next quarter, this Q2, given this July number declining by 15-20% and August probably would also decline, but September, because of the festival coming early, what could be the expected number for industry for Q2, given the inventory level is still much higher industry-wide?
Yeah, for Q2, we are expecting a small growth, maybe in the mid-single digit kind of a growth. And you are right, Mithul, July and August would be drop. July we have already seen is a drop. August would also be a drop, it seems. But September, because of the early onset of the festival period, there would be momentum both on the retail side, at least in the last few days of September, and of course on the wholesale side to build up stocks for the Dhanteras and Diwali and so on. There would be some pressure on some of the brands who are sitting on slightly higher stocks, channel stocks. So we will see how that pans out during September and October.
Thanks, sir. Last question on construction equipment side. What could be stable margin expectation and what are the levers for that going forward, considering commodity softening or pricing power or competitive situation there?
Yeah, Mithul, in the construction segment, we participate in three broad segments. One is cranes, the other is compactors, and the third is backhoe loaders. Right. So in the cranes, there are it's kind of a duopoly kind of a situation where there are only two big players, right? And therefore the pressure on inflation or because of inflation is normally not that high. The compactors is a altogether different story where there are many players in the segment, and of course there are intense pressures because of this inflation scenario, because of both the extent of the price increase and the timing of the price increase. Also, compactor is one segment where individual deals are made with the customers, sometimes directly also, and therefore the tendency to offer a certain price to capture the deal is actually even more. Backhoe loader we are a very small player. We operate in a niche, so therefore we don't really worry about competition that much because we just operate in a niche within a few customer segments. So overall, I say yes, all the businesses have been affected by inflation. But the impact in construction business is not as much as in tractor business because there is a play that is available to us, especially in the crane segment.
Thank you, sir.
Thank you. We have the next question from the line of Sonal Gupta from L&T Mutual Fund. Please go ahead.
Yeah, hi. Good evening, and thanks for taking my question. Sir, just sorry to belabor on the market share point, but one thing was that you'd anyway lost market share because of the the component shortages in FY21, and then 22 also we've sort of not been able to recover that. In fact, in the second half and in the first quarter, we've again underperformed. And this is very surprising because you have probably the strongest balance sheet, probably even better than the leader. So I'm just curious that why. I understand, historically the industry has operated balancing profitability, but I just don't understand, if the others are being more aggressive, why have you not chosen to defend your market share?
Yeah, so don't feel sorry about asking this question. In fact, we are equally worried about the market share story, and we were just waiting for the right time to go back at it. I don't know how to explain this, but different companies take different calls, especially in tough times like we are going through. in the last 1.5 years, mainly because of the inflationary pressures. And right or wrong, hard to say, but we had taken the call that we will kind of balance it maybe a little bit more than what competition has tried to do. You know that the pressure on profit is a little bit more on Escorts for the reason that our profitability is not at par with many of our peers in the industry. Although we have bridged the gap quite a lot in last 7 or 8 years, but we are still like 4 to 5% behind some of our peers. Right, so it's just a judgment call that we will have to take from time to time. I would request you to wait for a few months and see how this pans out. The market share story pans out now.
Sure. No, sir, why I'm asking this question is because what historically we've seen is that the market shares tend to be quite sticky, and it's sort of difficult to recover market share once it's sort of you lose ground there. So because now that you're saying that, okay, commodity prices are coming off, there's room for potentially being more aggressive, but that's true for the industry as a whole. That's not specific to you. So, essentially what gives you the confidence that you will be able to gain back that market share?
Yeah, as I explained, we have analyzed this in quite a bit of detail. You are right. I won't disagree with you that the market shares in our industry are sticky, right? But we haven't found any fundamental problem within the loss of this market share. The best thing is that we have lost in our strong markets and not in our weaker or opportunity markets that much, right? Which actually gives us that confidence that we can take it back. On the strength of our products, on the strength of our brands, and the strength of our channel. If it would have been the other story, where we would have gained in strong or lost more in weaker and opportunity markets, then we would have really worried. But I think the situation, we know the reason, and we know that we have very strong footing in these markets, and we should be able to take it back.
Got it. Just a related question: would financing have a role to play in this? Because clearly, what you're talking about, like haulage, etc., and the lower end segment, which are more price sensitive. Some people do have closer relationships with financing companies. So, excuse me, would that have impacted you?
Yeah, so we know that we do not have a captive finance company, and the brands that have a captive finance arrangement do tend to benefit in such times, in tougher times. Because when you have to increase prices every quarter, then a finance partner can really step up and help you with better LTVs, etc. Right? We do have that fundamental weakness in our whole story, and we would be working on that maybe in future sometime. But yes, you are right. It's not so much about the financing relationships, but having a captive finance always helps in tougher times.
Got it. And just lastly, could you talk about the corrective actions that you've talked about? So have you launched some newer products which you were sort of looking at?
It would be a 360-degree kind of approach. We would be looking at several things, and it would include repositioning some of the products in terms of variants, features, in terms of price positioning against specific competition or specific customer segments. It would also have some channel actions. It is also very important for us to bring that morale of the channel back up again, right? So it would be a 360-degree story. It would be a lot of market communication that we'll have to do around some of our new products that we had launched within last 2 years, and we haven't been able to make enough noise around them. So yes, it would be a mix of all those actions.
Got it, sir. Thank you so much.
Thank you. We have the next question from the line of Mihir Zaveri from Analysts Capital. Please go ahead.
Yeah, thank you for the opportunity. So, just going through what Sonal asked, actually, in terms of gaining market share going forward, and you saying that it is low to mid single digit growth for the full year, that means that we'll have very negligible growth or probably a decline for the rest of the year. On a sequential basis, sir, how we should look at it that while we will have some commodity easing, but the operating leverage will not be coming to us. Secondly, we'll have this market share gain strategy where, as Sonal mentioned, that everybody will have that advantage and everybody else will also try to aggressive. So is it fair to assume that the margins would remain in this range for some time before we can gain anything material in the coming quarters? That's my question, sir.
So mere margin obviously will depend on how the commodities market play now going forward. So there are two actions which were taken in the past. So one is how much the deflation happens now on the commodity side and how much impact you get. So as you know, last quarter we have actually passed on. This was the peak of the inflation. March and April month actually were the peak. So the price increases which have been given to suppliers are based on those peak levels now. So we're not seeing those peaks now are likely to come back. So only seeing the deflation happening now in the month of May, June, July also, which some softness has happened. And second is the pricing action which Shenu talked about. So we already took one price increase in this quarter also. So, but I know I think if you look at the last call also which we had mentioned there will be 4 to 5% unabsorbed inflation which will have an impact on the margin. And this was discussed, I think, quite a bit in the last con call and the last quarter results. So in spite of that, so there's about 2% or price increase which has been taken. So you still have 3.5% lag on the inflation side which you're carrying now. Either you get a deflation on the commodity side to that extent to offset it, or you get some further price increase movement happening maybe going forward, which looks difficult looking at the way the last 6 price increases have been taken now by the industry. So the absorption capacity of the customer looks very, very limited. So that may also be one of the reasons why you're seeing the market shifting towards the lower HP segment, so because of the price increases. So I think it will be a balance of the two. So it depends if the commodities price soften quite a bit and you get that advantage, maybe the margins can come back. But definitely next 2 quarters look quite challenging. I think by the time you get to the stable margins, so Q4 I think will be the period where we can look at some normalcy coming back to the margins front.
Got it, sir. Thank you. That's it from my side.
Thank you. We have the next question from the line of Hitesh Goel from CLSA. Please go ahead.
So my first question is on if I look at the Vahan registration data, and I think better way to look at the industry will be April to July rather than looking at, July month per se. So there has been a growth in UP. Actually, the state which has declined is mostly Gujarat, right? So UP is doing fairly well, although there is, correct me if I'm wrong, it depends a lot on water table, right? There because irrigation intensities from the ground level is quite high. So that is my first question. You can talk about that. Second is on the what Bharat said right now. There's still 3.5% cost inflation left. Are we talking from this quarter or are we talking about peak margins from the peak margins? Because commodity prices have declined significantly from the fourth quarter level, especially steel. So not able to reconcile this, if you can talk about it.
Yeah, Hitesh, I'll talk about the market first. So yes, UP, has been sitting on a kind of a low base because UP hasn't grown as much as some of the other markets have grown in the last few years. So I think it is time for UP to probably come back. And we should see good momentum in UP in this year and next year probably as well, which should help us because we are quite strong in UP. And you are right. I mean, it mostly depends on the water table, and the water table situation is quite good right now, even in North India, right? So even if like UP has certain deficiency in rainfall, we are not too much worried. The momentum on the ground is good in UP. Bihar also should catch up, it seems, maybe after the Vishwakarma Day, because the on-ground momentum is quite good, even in Bihar now. I'll pass on to Bharat for the other question.
Yeah, it is. So I think as we mentioned in the last con call, so that time we said there's a 4 to 5% of unabsorbed inflation which will remain by end of Q1. Already we were comparing it against the level of margin which was there in Q4, which is roughly 16%. So even the 3.5% is against that level only, not against this quarter.
And sorry, just to clarify on that, so basically, when does the steel price contracts come for renegotiation? Because spot is down like 15% from the fourth quarter levels. So that would be a big jump on margins, right? If the pricing remains stable. So when is that?
I think in tractors it's not just steel. So it's a combination of castings, forging, steel, and then on the proprietary parts. So all these four play an important part, and there are different benchmarks used in the industry to get the price changes done in the purchase order. But normally in the past we had actually been doing these changes on a quarterly basis. But because this peak happened in March and April due to war situations, so suppliers were under a lot of pressure, and we actually ended up giving them the inflation based on the month average, for the March and April. So that's saying when we look at the data now for the margin, last quarter we given the inflation at a peak level now. So we don't see any more downside should happen, even though we are hearing that there's a rubber price movement happen upward, but we expect that should get offset with the decline which is looking at in the steel prices now going forward. So, but still, in spite of the pricing action taken in Q2, still there will be some unabsorbed inflation which will still be there unless we see major drastic reduction happening on the prices on the steel side in the next 2 months.
Okay.
Ritesh, just be a little careful about your influence on Gujarat because as you might be aware that sometimes Gujarat has a tendency Gujarat customers have a tendency to delay their registrations just because of some subsidy issues, right? So.
Yeah. So July, August was very high months, and then it normalized. Maybe there's some registration issues. Yeah.
Right.
Thanks, Chin. Yeah.
Thank you. Participants are requested to please restrict your questions to 2 per participant. Participants are requested to please restrict your questions to 2 per participant. We have the next question from the line of Jinesh Gandhi from Motilal Oswal. Please go ahead.
Hi, sir. My question is continuing on the steel price discussion. So based on the current steel prices, should we see a good reversal in the RM cost in 2Q and beyond? The prices remain where they are?
Yeah, Jinesh, so normally we follow the benchmarks, on this commodity prices. So the leaders who do the settlement with the steel suppliers. So there are players who are the large players, or there's a large association who do this closer. So we normally follow them. So yes, if they get the benefit, industry get the benefit, then we also follow them. So if they give a deflation benefit, then we'll also get that benefit.
Okay. And what was the cost increase on account of commodity in 1Q?
So normally in the last quarter we had almost 5 to 6% increase in the commodity side, and this was again like I said based on the peak levels of March and April commodity prices.
Okay, 5 to 6% increase in the RM basket in 1Q. Is that what you're indicating? Hello?
This is the operator here. The line for the management has dropped. We are reconnecting them.
Sure.
Over to the management.
Sorry, Bharat, I was clarifying on, you said 5 to 6% increase in RM basket over fourth quarter. Is that right understanding?
Yeah, so that is the case in Q1, which is what I think is getting factored in the financials too. And if you look at the commodity cost, material cost price, even though the overall company level looks like it's only 2% increase which has happened, but effectively because the higher production volume in this quarter compared to Q4, and also because of this some impact of the price increases, so the impact normally would have been about 4%. So that's something I think which will probably get reflected going forward on an exit basis in Q2. So which is why I mentioned, I think Q2, Q3 is going to be a tough quarter. So depending on how much benefit we get from deflation, and there's no further pressure on the commodity side, like we are again hearing on the steel prices side, government is going to relax export duty, which can again maybe put some pressure on the price, which were early coming down. They get again stabilized and they start moving up slightly from the current level. So it's very difficult to predict, but whatever happens to those prices, these are something which the industry will follow and will also get the benefit of the disadvantage either way.
Sure. And the price hike taken in second quarter is what, again, 2% or higher than that?
Yeah, it's roughly 2%.
Okay. And lastly, a clarification, when we are saying there is a shift towards lower HP segment, primarily, are we indicating there is a recovery in the commercial segment which is now visible in a material way?
And Dinesh, it's actually, like I said, it's actually a kind of a correction. In FY21, we had a huge jump in 40 and above HP segments sales at the industry level. And there is some correction happening since FY22 itself. Commercial segment is coming up, but not very, very strongly so far. But we are expecting that from September or October onwards, commercial segment should also play well.
Okay, got it. And Bharat, can you talk about the Capex for FY23, what we are looking to invest?
So Capex for this year, our plan was to do about 300 to 350 crores sort of Capex. So right now in the first quarter, the cash flow has not been much. So I think it's only about 40 to 50 crores, Capex which has happened. But going forward, we expect that pace will get picked up. So we're still maintaining the same guidance it is for this year.
Got it. Great. I'll fall back in queue. Thanks.
Thank you. We have the next question from the line of Chirag Shah from Edelweiss. Please go ahead.
Yeah, thanks for the opportunity, sir. So my first question is again on the commodities, and apologies for hopping on it. So if I understood correct that in Q1, your indexation was based on the highest price because you followed a monthly average basis, right? So when the commodity has started falling, the impact should also be in similar fashion for us in Q2. Is it right understanding? First point.
So earlier we used to give it on the quarterly average basis, and this time because of the spike which happened in the month of May and March and April, we had to convert to the monthly one to continue our supplies on the production side. So going forward, the correction which is yet to happen, obviously will again be, this was a one-off thing, which happened. So it doesn't mean that we're shifting to monthly now. We will continue to follow the quarterly cycle only, so that benefit will come on a quarterly basis. But obviously that will factor in whatever the reduction has happened in the month of May and June also.
And so secondly, on castings and forging and other aggregates, what is the impact of the conversion cost inflation? Is it already there or there is some lag effect pending?
So that is another issue which suppliers are raising, which is why you're finding it difficult for the industry to really take back the deflation because the process cost was not factored in when the inflation was given. So this is I think, struggle with most of the industry players are today dealing with. So it depends on now how much process cost gets settled and whether we need to adjust that in the deflation or not. So that will define how much benefit we get because of commodity price movement. So that is why we said it's very uncertain as of now because the industry hasn't settled those prices and suppliers are demanding process costs too. But there again the inflation has happened. So that may actually get, maybe lead to some lower benefit coming because of deflation on the commodity side. But again, that will be something which the industry will decide and we'll also follow the same benchmark what the industry does.
Okay, so some lag effect of that could come in Q2. That is the right way of looking at it, and probably Q3 onwards it would be more cleaner quarters on the commodity side, including the aggregates.
Yeah, that's right.
Okay. So secondly, just a follow-up question again. Is the underlying demand turning slightly weak? Because April, May was suddenly a very strong month, then June was reasonably okay, not as strong, then suddenly we are seeing this. Is the demand turning relatively weak and hence inventories are slightly higher and OEMs would look at clearing the inventory and bringing it to normalized levels? Or is this more of a blip last 1 month or 45 days?
No, we don't see any let-up in the demand actually on the ground. I mean, all the factors are in favor of the tractor industry right now. I mean, when we compare month-on-month or monthly positives and negatives in the industry, we have to just look at the base effects also of last 2-3 years were very, very kind of inconsistent, right, that way. So yeah, I mean, if July and August are down, then we are really expecting a very good September, October, and November. Also, we must remember that FY21 was an unusual year where the industry reached its ever highest, and that was also abnormal for the industry to grow to that extent just in a single year. So therefore, some correction, of course, is bound to happen. So I mean, if we look at FY19, FY20 base, then we would get a better sense of how industry is moving.
Just last one clarification. So generally,
the operator here would request you to kindly get back in the queue for follow-up questions.
Yeah, sure.
We have the next question from the line of Abhinav Chanda from Ratanbali Investment. Please go ahead.
Yeah, thanks for taking my question. I just wanted to understand the entire merger process. Where is it right now?
So merger, still I think the advisors are working on the valuation side. So obviously we intend to have this meeting soon. So I think once the agreements are finalized and the valuation is done, so we'll really get it done. So maybe another, I'd say maybe a month or so.
Okay. So the valuation part is being worked out by advisors, but then the management has already indicated 1 to 2% is the maximum dilution which will happen. Even in my last call, I had asked the same question. And so how long would be the timeline for you to draw the final parlance for the merger?
So the court process obviously may take 9 months to 12 months because this will have to go through the stock exchange permission, SEBI approval.
No, I mean finalizing the terms of the merger. The entire regulatory process will take 12 months. That's okay.
So I said within a month. So we're indicating about a month time, so we should be able to close that.
And on the cancellation of shares held by the trust, so we have received approval sometime in June. It was mentioned in your press release. So by when do we see the actual cancellation getting reflected in the shareholding pattern?
So again, this will be a court process. So the shareholders' postal ballot is on right now. So once the results get over, then we'll file the scheme with NCLT for reduction. And then again, it's a court process. It may take again about 6 months' time by the time it becomes effective.
Okay. And on your business plan, by September, do we expect the business plan to be out? Because earlier we were indicated Q1, then it shifted to July. And right now on this call, you have indicated September. So by September, do we expect
the internal approval process which will follow, and then obviously we'll make it public to the investors in the third quarter.
Okay. Thank you. Thank you so much.
Thank you. Participants are requested to kindly restrict your questions to one per participant. Participants are requested to kindly restrict your questions to one per question per participant. We have the next question from the line of Vikram Damani from Damani Securities. Please go ahead.
Hi, thanks for your time. My question was to do with the medium-term business plan with the previous participants asked. Thank you.
Thank you. We have the next question from the line of Samir Deshpande from Fair Deal Investments. Please go ahead.
Hello, good afternoon. I would like to know, after this cancellation of equity, the equity capital will be around 110 to 11 crores, and the stake of Kubota will be around 53.5%, and Nandas will be continuing to hold 14%. So is it correct?
Yeah, post-reduction, that will be the sort of percentage around that, yeah.
Okay. And what is the cash and bank balances position now?
So liquidity will be close to 5,000 crores of investment, which we have on the market as of end of June.
Okay, thank you and all the best.
Thank you. We have the next question from the line of Mitul Shah from Reliance Securities. Please go ahead.
Sir, thank you for giving opportunity again. So one clarification on Q2 tractor industry number again. Is we expect decline roughly around 15-20% possibly in August, similar decline in July. So even if we assume record high number for September, best case comes to roughly more or less flat volume. So growth seems to be very difficult. So do you expect inventory levels to remain high, or do you expect inventory would correct but retail sales would be like 130, 140 in the month of September? Assuming current inventory level close to 140K now.
So, Mitul, July, August could be low. We are still looking at roughly like 215,000 for Q2. That is what is our ballpark estimate. So that is why I said it could grow into like low or mid single digit.
So secondly, on your strategy in North, we are losing market share, and again, this northern state, particularly UP, Bihar, facing problem in last month of July and probably because of the uneven monsoon. So what could be the strategy here? Because our stronger markets are also declining and we are losing market share there.
Yeah, Mitul. So as I said, we have completely analyzed it, state by state, cluster by cluster, even at the dealership level, and we know, in which areas or which tehsils we have lost against which competition in which customer segment, right? So we are, as I said, we have very, very strong brand perception with at least one of our brands in these markets. We have a very, very strong channel. In many areas, we have been either number one or number two, right? So using that strength and taking some corrective actions wherever required, especially in the identified segments, we should be able to come back.
Yes, sir. My question is in terms of whether it would be product strategy, pricing strategy, or are we expecting network expansion in those territories? Anything, if you can throw some more light.
No, network expansion, Mitul, we don't need. We are quite saturated with our network in our stronger markets. Like there are only like a handful of white spaces, only that is because of some kind of churning that we see sometimes. But otherwise, there is no need for any network correction. Yes, we are going to work on the product. We are going to work on the right optimal price. We are going to work on introducing some variants that we need to respond to competition with. And we are also going to work on the dealer profitability side a little bit because of the frequent changes in prices. There is always a lag effect between our raising the price and the customer giving that increased price, right? So dealer profitability, etc., is also a little bit weakened, right? So it is going to be a 360-degree approach. We are also going to make a lot of noise about some of the new products that we have launched in 1.5 to 2 years, such as the Powerhouse series, the next series in Power Track, and similarly some new series in Comtrack. Right, so it's going to be a all-round approach. We don't think a single lever will work. We'll have to accelerate on many levers.
Thank you for detailed explanation, sir. Sir, lastly, if you can give some details on the EV tractor side. I think we are selling 50-60 units monthly to USA, right, sir?
Yes, that is right. We are selling to US and we are selling in Europe also a few units. As you are aware, we have not commercially launched it in India yet, although we are making just a handful of supplies to few government agencies in India. So EV, as I have been saying, we are very cautious to ramp it up because we wanted to go through a complete cycle of like customer validation or market validation. So yeah, there is a lot of potential. We have a lot of orders that we want to serve, but cautiously we are moving on this front.
Yeah, great, sir. All the best, sir, for EV especially.
Thank you, Nitin.
We have the next question from the line of Sridhar Kalani from Axis Securities. Please go ahead.
Thank you for the opportunity. So I have a question regarding exports as to how will the currency depreciation, will it be playing to our advantage, and how is the export segment wise, which countries are we exporting mainly to? If some light can be thrown upon that.
Yeah, and so of course the forex or the exchange rate will have its own bearing. But also remember that some of it gets negated with the inflation, which is also happening on the export products. As far as the markets are concerned, we will tell you a little bit more about which markets we will focus, etc. Where we will go direct and where we will use Kubota's strength, channel strength. So that we will explain to you in the MTBP discussion we will have with you. But largely speaking, you know that we have a subsidiary in Poland, so some of the tractors are exported through Poland. Europe is very, very strong for us. We are also supplying to Kubota in Europe through their channel. But we have a lot of other markets where we are regularly supplying, such as Mexico, Sudan, UK, Chile, ASEAN countries, etc. Right? So let us just come back to you. We have huge aspirations on exports. We know there is a huge potential there. So we'll come back to you during the time of our MTBP discussion.
But just on the exchange side, just to further update what Shenu mentioned, this is Bharat Karan. So as you mentioned, so most of the exports right now is happening in the euro denominations. Almost 66-70% exports are in euro. So where the exchange benefit is not really there. So if you look at dollar, euro are more or less now coming at par. So if it was the dollar invoicing or billing, then obviously you would have got that advantage. So that is happening only on certain volume, 30% of the volume, what we are exporting today. So on the euro side, we are not going to see any major benefit coming on the exchange front.
Sure, sir. Thank you so much.
Thank you. We have the last question from the line of Chirag Shah from Edelweiss. Please go ahead.
Yeah, thanks for the opportunity again, sir. Sir, just a clarification, and you have partly answered that. You indicated that there is a reasonable stickiness of brand in the region where you perform, generally for the industry as a whole. So the loss of market share cannot be attributed to the pricing actions adopted by peers. That cannot be the single biggest driver, because the pricing action can never be so distorted that it could change the mathematics by 10-15% in 1 month. So I presume it is more to do with your dealer, the way you are trying to restructure the dealer post the Kubota integration process. Is that the driver of some of the market share losses?
No, not at all. We haven't started even a bit around any kind of channel integration with Kubota, and neither do we want to in the short term or even in the midterm. Right? We are very, very clear that all the three brands have unique strengths, and they cater to different kinds of customers in different segments. And therefore, we would like to maintain a unique channel. Of course, there would be some synergies in channel that we would explore, like if we have a strong dealer and they want to have another dealership of a different brand within EKL, then of course we'll be more than happy to explore those kind of synergies, right? So it has got nothing to do with the integration process. I do understand that what you are saying may generally be true, but see, like I specifically said, that these are markets where price sensitivity is very, very high. Okay. For example, the haulage market, etc. Generally, you are right. The price should not affect so much if the brand is very, very strong, right? But depends on the quantum also, which I haven't described yet. But yes, these are price sensitive segments.
Thank you very much.
Thank you. That was the last question. I now hand it over to the management for closing comments.
Thank you, ladies and gentlemen, for being present on this call. For any feedback and or queries, please feel free to write into us at investorrelations@escorts.co.in. Thank you very much and have a good evening. Stay healthy and stay safe.
Thank you. On behalf of DAM Capital Advisors, that concludes the conference. Thank you for joining us, and you may now disconnect your lines.